Americans are quietly getting poorer, and most people don't even realize it. The US dollar index has fallen nearly 11% in the first half of 2025. That is the steepest decline since 1973. Decades the world viewed the dollar as a fortress. Now cracks are starting to show. When the dollar weakens, it buys less of everything abroad. Vacations overseas get more expensive, imported goods like electronics and coffee cost more, and savings held in cash lose global value. For years, Americans enjoyed the opposite trend. Since 2011, the dollar rose by more than 36% compared to other currencies. This made Americans wealthier without lifting a finger. Groceries from abroad felt cheaper. Traveling to Europe or Japan was a bargain. Even foreign investments returned more in dollar terms. But that era may be over. The current shift is not a blip. It reflects political choices and economic pressure designed to push the dollar down. And if history is any guide, the slide could last for years. Think about it this way: if your paycheck stays the same, but the money in your wallet buys less on the world stage, you just got a hidden pay cut. And that is what millions of Americans are now facing. The real question isn't whether the dollar is weakening, it's how you protect your own financial future when it does. The passive path is about building wealth step by step, even in times when a currency you depend on loses ground. Because if you prepare correctly, a weak dollar can actually open doors to new opportunities. So the challenge for you is simple. Will you let the dollar decline, eat away at your wealth, or will you position yourself to benefit while others fall behind? To understand what is happening, we need to start with the basics. The US dollar index measures the value of the dollar compared to a basket of major world currencies. This includes the euro, Canadian dollar, the Japanese yen, the Swiss franc, and a few others. When the index rises, it means the dollar is stronger than those currencies. When it falls, it means the dollar is weaker. For most of the last decade, the dollar was rising. Since 2011, it gained more than 1/3 in value. Against the euro, it climbed over 27%, against the yen nearly 80%, and against the Australian dollar more than 60%. That strength gave Americans extra purchasing power. It felt like getting a raise without doing anything. Foreign vacations became cheaper. Buying imported goods felt easier. Even overseas investments delivered stronger returns when converted back into dollars. But the cycle is changing. The dollar has already started to slide. And history shows that when momentum shifts in currency markets, it rarely stops quickly. The forces now pushing the dollar down are strong and deliberate. A stronger dollar helps American consumers, but hurts American exporters. When the dollar is expensive, foreigners find US goods too costly. That widens the trade deficit and reduces manufacturing jobs. This is why leaders like Donald Trump have openly pushed for a weaker dollar. He wants US products to be more competitive abroad, and he is applying pressure on the Federal Reserve to lower interest rates and weaken the currency. That means the government itself is steering this shift. It is not just market forces at play, it is a conscious choice to tilt the playing field. If policy continues in this direction, the dollar will keep sliding. If you are not prepared, your everyday expenses will rise while your savings lose ground. The dollar's fall is not just a chart on a screen, it is a silent tax that touches every American household. One of the biggest forces behind the dollar's direction is interest rates. When US rates are higher than those in Europe or Japan, investors prefer to hold dollars. They earn more yield and enjoy a safer asset. That has been the case for much of the past decade. Right now, US interest rates stand near 4.5%. In Europe, the central bank sets rates closer to 2.5%. That gap makes dollars attractive to global investors. It explains why the dollar remains strong for so long. But that spread is starting to shrink, and the political pressure is building to shrink it even more. Donald Trump has made it clear he wants cheaper money. Lower rates mean easier borrowing, but they also mean a weaker dollar. The Federal Reserve is already under pressure from the administration, and the next appointees to the Fed will likely favor cuts. If rates fall sharply, the dollar's advantage disappears and foreign currencies gain strength. Think about it like this. For years, holding dollars was like having a savings account with a higher interest rate than your neighbor. Now that premium is about to vanish. When it does, investors will look elsewhere. That shift can unleash large flows of money into other markets. It can boost European assets, Asian markets, and commodities like gold that thrive when the dollar retreats. This change is not random, it is policy-driven, and if the pattern holds, the dollar could lose much more value before finding a bottom. The question every saver and investor must ask is simple. If the dollar no longer gives you the best return, where will you put your money next? EAR is another way to measure the strength of the dollar. It is called the real effective exchange rate. This index is calculated by the Bank for International Settlements. It adjusts for inflation and compares the dollar across many trading partners. At the beginning of this year, the index for the US dollar stood at 112. That level has only been seen twice before, once in the mid-1980s and once in the early 1970s. Both of those times marked peaks before major declines. Today, the number remains near the very top of its historical range. That means the dollar is still considered overvalued and there is plenty of room left for it to fall. If the index simply returned to its long-run average of 90, that would equal another 15% drop from current levels. And if it overshoots on the downside, as currencies often do, the fall could be even greater. This is why betting on a quick rebound can be dangerous. The dollar may look weaker than last year, but compared to history, it is still expensive, and expensive assets rarely stay expensive forever. For ordinary Americans, this matters more than it seems. A decline of 15 to 20% in the dollar means higher prices for imported goods, it means less power when traveling abroad, and it means a slow erosion of wealth for anyone sitting on cash. But for investors who are prepared, it also means the chance to profit from assets that move in the opposite direction. Gold, foreign stocks, and alternative assets like Bitcoin often rise when the dollar falls. The cycle is clear. When the dollar is strong, you enjoy cheap imports and easy travel. When it is weak, the world becomes more costly, but other assets shine. The key is to recognize where we are in that cycle. And today, the evidence points toward further weakness. Government spending is another major weight on the dollar. When the deficit grows, confidence in the currency shrinks, investors see more debt and less discipline, and they demand lower prices for holding U.S. assets. Right now, new policies are adding trillions to the national deficit. Cuts in areas like renewable energy and Medicaid are outweighed by large tax reductions. The result is more borrowing over the next decade. The added cost is estimated at $4.5 trillion. History shows what happens when deficits expand. In the 1990s, spending restraint helped the dollar rise. In the early 2000s, widening deficits pushed it lower. In the early 2010s, smaller deficits again lifted the dollar. And in 2021, a brief tightening improved confidence before new waves of debt weakened it again. The pattern is consistent. Tighter budgets support the dollar. Wider deficits weaken it. With massive new borrowing now in motion, the direction is clear. The dollar faces more pressure to fall. This will not happen in a straight line. There will be rallies along the way, but the long-term trend points down. For the average American, this means the government is silently chipping away at the value of money in your pocket. Every budget vote in Washington has ripple effects on the price you pay for groceries, the cost of your next car, and the return you earn on your savings. If deficits continue to balloon, the dollar will not be able to hold its past strength, and households will need to plan for a future where the money they earn buys less than before. A weaker dollar creates both winners and losers. Exporters are among the biggest winners. When the dollar falls, American goods become cheaper for foreign buyers. That boosts sales abroad and supports industries like farming and manufacturing. Investors in foreign markets also benefit. When you hold stocks in countries like India or Argentina, a falling dollar means your gains convert into more dollars when brought home. This is why global funds often perform better during weak dollar cycles. Assets tied to scarcity, such as gold, often rise as well. For centuries, gold has been a safe haven when currencies decline, and in recent years, Bitcoin has begun to play a similar role for some investors, but there are clear losers too. Anyone who relies heavily on imports pays more. Electronics that depend on parts from Asia become more expensive. Groceries that include foreign products like coffee or olive oil cost more. Families traveling abroad see their dollars stretch less for hotels and meals. Savers who keep most of their wealth in cash lose purchasing power quietly. Even if their account balance looks the same, the real value of that money shrinks on the world stage. The truth is, every weak dollar day is a transfer of wealth. Some households see their assets grow in value, others see their paychecks buy less. This is why understanding the cycle matters. If you adapt your strategy, you can place yourself on the winning side of that transfer. If you ignore it, you may find your wealth slipping away without warning. A falling dollar also reshapes the landscape for investors. It changes where the best opportunities can be found. In the United States, stocks and real estate may rise in price, partly because assets are measured in dollars. When the dollar weakens, it takes more of them to buy the same property or share of stock. This can make portfolios look stronger, even if the real value is unchanged. The larger potential lies outside the country. Emerging markets often thrive when the dollar is falling. Nations like India benefit from stronger local demand and easier access to global capital. Argentina and other developing economies can also see inflows as investors look for higher returns abroad. Commodities gain momentum too. Gold is one of the most reliable hedges against a weak dollar. Bitcoin has shown similar behavior in recent years for investors willing to take on volatility. These assets can be powerful tools for protection. The path forward is not about chasing quick trades. It is about positioning wisely, allocating part of your portfolio to assets that rise when the dollar falls, balancing domestic exposure with international opportunities, and thinking ahead instead of reacting late when the dollar weakens. The door opens for those who are ready. The same shift that erodes savings can create new streams of wealth. Preparation is what separates the two outcomes. So how can you protect yourself when the dollar is sliding? Like, the first step is diversification. Do not keep all of your money in cash. Cash loses value fastest when the currency weakens. Consider holding foreign exchange traded funds. These let you own stocks from other countries without leaving a U.S. brokerage account. When the dollar falls, the value of those foreign shares often rises in dollar terms. Set aside part of your savings in assets that have a history of moving opposite to the dollar. Gold is the classic choice. It holds value when currencies stumble. Bitcoin is another option, though. It comes with more volatility. Even a small position can act as insurance against a weak dollar cycle. Think about bonds that adjust for inflation. Treasury inflation-protected securities help protect purchasing power. They pay more when the cost of living rises. A practical way to start is with simple numbers. If you have $10,000 to invest, you might place $6,000 into U.S. stocks and real estate, $2,000 into international funds, $1,000 into gold, and $1,000 into Bitcoin or other alternatives. This is not about chasing the hottest trade. It is about spreading your bets, so one weak link does not sink the entire chain. At the household level, plan for higher costs on imported goods. Groceries that rely on coffee beans or spices may go up. Electronics could rise as parts become more expensive. Budget a little extra for these items so you are not caught off guard. Wealth building is not about timing the perfect day to buy or sell. It is about steady steps that keep your future secure, no matter what the dollar does next. The passive path is about turning those steady steps into lasting wealth, and this moment is a chance to take action before the slide goes further. The dollar has always moved in cycles, periods of strength followed by years of weakness. In the 1970s, the dollar plunged after the gold standard was abandoned. In the mid-1980s, it fell again after reaching unsustainable highs. In the 2000s, it weakened as deficits ballooned and interest rates dropped. Each cycle teaches the same lesson. Currencies are never stable forever, and those who treat the dollar as untouchable often get caught off guard. The smartest response is not prediction, but preparation. You do not need to guess the exact day the dollar will fall. You need to build habits that protect your wealth, no matter what stage of the cycle we are in. That means diversifying beyond cash, holding assets that thrive in weak dollar periods, and stay informed about how government policy and interest rates shape the value of your money. Financial literacy is the best defense. If you understand the forces moving the dollar, you can see beyond the headlines. You can prepare your household budget, your savings, and your investments. Most people will react too late. They will wait until prices rise at the store or until their vacations cost double. By then, the damage is already done. The advantage goes to those who act early, who learn the patterns, and who position themselves before the crowd moves. Wealth is not built by luck. It is built by preparation, and preparation is exactly what separates those who benefit from currency cycles from those who get left behind. Here are 3 key lessons to carry forward. First, never rely solely on the dollar. Holding all of your wealth in one currency exposes you to risks outside your control. Spread your savings across assets that are not tied to a single outcome. Second, learn to see weakness as opportunity. A falling dollar makes imports costly, but it also lifts the value of assets that move the other way. By owning some of those assets, you turn a national problem into personal growth. Third, focus on long-term resilience, not short-term noise. Cycles rise and fall. Headlines change every day, but consistent investing in diverse assets builds a shield that lasts through any trend. Even small steps matter. Allocating a portion of your portfolio abroad, keeping some money in gold or Bitcoin, planning your household, budget for higher costs. These choices compound over time. The passive path is built on simple steps like these. It is about creating stability in unstable times and proving that you do not need perfect timing to build wealth. You need steady preparation. The dollar may weaken, but you do not have to. Your financial future depends on what you choose to do right. Now, so take action today, like this video, subscribe to the channel, leave a comment with your thoughts, and share this with someone who needs to hear it. Your support helps this community grow, and it may help someone else protect their wealth before it is too late. Stay consistent, stay prepared, and keep walking the passive path. I will see you in the next video.